Good morning, everyone. You're all very welcome. My name is Turley, and I head up our Fintech, Financial Services and Cybersecurity team here in Enterprise Ireland. I'd like to thank you all for joining us today as we break down the latest changes to EU payments and e-invoicing legislation and what this will mean for Irish SMEs. Thank you for being with us, as this is the final session of our six-part series delivered in partnership with Vulcan Consulting, designed to help you navigate evolving European and national policy. The goal of this series has been to demystify complex legislation and provide you with practical insights and actionable advice. Over the next hour or so, we will unpack what you need to know about the EU payments and e-invoicing and answer any questions that you may have. I'm absolutely delighted to be joined here today by a fantastic panel of speakers. To begin with, we will have Clarke and Niamh Murphy from Vulcan Consulting, followed by Ruth McCarthy, Head of Compliance, Risk and Policy for the Fexco Group, and Bernie Neville, Senior Client Advisor from Enterprise Ireland. If you do have any questions during the session, please feel free to put them into the chat function, which is available, and we'll have time to address some of these at the end. We would also like to note to everyone before we commence that this session is being recorded. With that, I'll hand over to Una and Niamh to get us started.
Good morning, everybody, and thank you, Anna-Marie. My name is Una Clarke. I'm a Senior Account Director at Vulcan Consulting based in Brussels, with over 10 years of experience in Brussels at the intersection of policy and communications working on European affairs. I'll now hand you over to my colleague, Niamh.
Hello, everyone. So my name is Niamh. I'm an account manager at Vulcan Consulting in the Brussels office. I hold 3 years experience in the Brussels landscape, specializing in policy monitoring and also research into regulatory changes in areas such as health, trade, and financial services. I'll now pass over to Ruth to introduce herself.
Ruth, I think you're on mute there.
I'm sorry, you missed some fantastic content there, folks. Hi, I'm Ruth McCarthy. I'm the Head of Risk and Compliance for Fexco Group. I'm very active in the area of financial services and fintech policy. I'm a member of the Industry Advisory Group on the Ireland for Finance strategy. And my area of expertise, by way of background, I was a solicitor specialising in financial regulation before moving into commercial roles here in Fexco.
And good morning, everyone. My name is Bernie Neville, and I'm a Senior Client Advisor in the Enterprise Ireland Fintech and Financial Services Department. So today I will provide you with a brief overview of Enterprise Ireland digitalisation and R&D supports, which may be available to you to help you address some of the impacts or opportunities arising from the topics covered today.
Thank you very much. So at Vulcan Consulting, we work at the intersection of both Irish and EU policy and how it affects business operations, helping companies to translate legislation into practical systems that work on the ground. However, today we step back, not just looking at one piece of legislation, but talking about the payments and e-invoicing regulatory environment at large to help your business understand what to expect and prepare for. So to begin with, let me briefly walk you through developments in payments, VAT, and electronic invoicing. At its core, this legislative package is about harmonisation and modernisation. The main objective is to establish clearer and more harmonised rules across the EU and reduce differing approaches between different member states. A secondary objective is to provide legal certainty for innovation. The EU wants to create a framework that allows new payment models, digital invoicing systems, and fintech solutions to scale safely within the single market without regulatory grey zones slowing them down. And finally, the legislation aims to strengthen governance, enforcement, and market integrity. That means clearer supervisory powers, stronger compliance mechanisms, and a more robust framework to ensure fair competition and consumer protection. In terms of scope, on the payment side, the rules apply directly to payment institutions and businesses operating in this space. This has practical implications for how companies structure compliance, reporting, and operational models. It is also important to understand the legal instruments involved, which we will go into more in a moment. To note, however, there are 2 types of legislation that make up this package. First of all, there is a regulation, which is directly applicable in all member states. It does not need to be written into national law, which we call transposition. This ensures uniform implementation across the EU. In contrast, a directive must be written into national law, which can lead to some variations in how member states implement the rules. Ultimately, the EU is aiming for one end goal, a payments and VAT environment that is more digital, more integrated, and more accessible, while maintaining trust, security, and market stability. Now I'll hand you over to my colleague Niamh to get more into details on the payments.
Okay, so let's step back and look at why we are here. So the EU has been trying for almost 20 years to create a truly single payments market. PSD1 was the first big step. It opened up payments beyond banks and allowed new players to enter the market, and this was transformative. Then PSD2 came along. This introduced open banking and strong customer authentication, but in practice, it didn't work as consistently as intended. So banks interpreted requirements differently, enforcement varied across member states, and national discretion led to legal fragmentation. Fraud also evolved, and this exposed weaknesses in how the framework was applied. So the Commission eventually realized something important. Operational payment rules must be identical everywhere, even if supervision remains national. So a simple analogy here can help. Think of PSD3 as the law that decides who is allowed to open a restaurant. The Payment Services Regulation, or PSR, on the other hand, sets the hygiene and service rules that apply once customers walk in. So the goal will be uniform standards across the EU, even if inspections are carried out nationally. Now shifting to VAT and e-invoicing, the structural problem is similar. So the EU VAT system was designed for quarterly returns and paper invoices, but today's economy is digital, real-time, and cross-border. So we are trying to apply paper-era tax logic to a platform economy. The consequences of this were significant. So first, the EU faces a 100 billion annual VAT gap, the difference between the VAT that should be collected and what governments actually receive. Second, the current system enables a persistent cross-border carousel fraud. So this involves goods repeatedly being moved across member states to claim VAT refunds on transactions where the tax was never actually paid. And then third, reporting systems remain fragmented across member states, creating compliance burdens, legal uncertainty, and higher administration costs. So this is where VAT in the digital age, or ViDA, comes in. It represents a structural shift from periodic after-the-fact VAT declarations to transaction-based digital reporting infrastructure. So in other words, VAT must move from static paperwork to real-time data. So taken together, payments reform and VAT digitalization reflect the same strategic logic. Harmonise rules, close enforcement gaps, reduce fraud, and modernize Europe's financial architecture for a digital economy. So looking at how money moves, this reform splits EU payment law into two pillars, the Payment Services Regulation, or PSR, and the third Payment Services Directive, PSD3. And the key shift here is from minimum harmonization to operational uniformity across the EU. So let me break this down. PSR defines how payments must function in practice. This is about what happens when someone clicks pay. It sets out how payments must work, execution rules, consumer rights and liability, and fraud and transparency rules. So because this is a regulation, it applies directly across all member states. The operational rules are identical everywhere. For cross-border businesses, particularly Irish SMEs selling into the EU, this is significant. It will remove fragmentation and creates predictable compliance conditions. So PSD3 defines who is allowed to operate in the payments market. It covers who can be a payment institution, authorization and licensing, supervision and enforcement, and institutional structure. So in short, PSD3 determines who is allowed to exist and how they are supervised. Because this is a directive, it must be implemented into national law. So in Ireland, for example, the framework will still be transposed nationally. And there will be 4 major practical shifts. 1, stronger fraud rules. 2, verification of payee. 3, open banking 2.0. And lastly, clear liability and refund rights. So payment service providers are regulated and bear most of the obligations under the framework. These also fall into 3 main categories: banks, electronic money institutions, and payment institutions. The scope also extends to PSP structures such as agents, branches, and distributors, meaning that the regulatory perimeter captures not only the core licensed entity, but also those operating under its umbrella. These entities are responsible for compliance with capital requirements, governance standards, fraud prevention rules, transparency obligations, and customer protection measures. So in contrast, most businesses, including the majority of SMEs, will interact with the framework primarily as payment service users rather than as regulated PSPs, although some may operate as agents or intermediaries depending on their business model. So payment service operators provide infrastructure such as card schemes and settlement systems. Payment service users are those placing a payment order, so payers or the payees. Most businesses fall into this category. Technology, cloud, and data service providers will remain largely outside the core payments framework. However, they may fall under legislation such as DORA. So I will now pass you back to my colleague Una to speak about the VAT and invoicing.
Okay, so when it comes to ViDA, VAT in the digital age, it amends the 2006 VAT Directive and represents a structural reform of how VAT operates in the EU. Importantly, this is not one single legislative act, but it's a package of 3 instruments. 1, a directive, which changes the VAT rules themselves. 2, an implementing regulation, which sets the technical mechanics, including formats and reporting content. And 3, an administrative cooperation regulation, which ensures tax authorities exchange transaction-level data in near real time. The package was formally adopted in March 2025 and will roll out in phases between 2025 and 2030. ViDA operates through 3 pillars. Pillar 1, e-invoicing and digital reporting. This is the most significant pillar, particularly for Irish SMEs. It introduces structured electronic invoices, real-time or near real-time transaction reporting, replacement of recapitulative statements. This shifts VAT from periodic retrospective reporting to transaction-based digital reporting infrastructure. But Pillar 2, the platform economy, this changes VAT liability in certain platform models. Platforms can become the deemed supplier and therefore liable for VAT in specific cases. This applies particularly to short-term accommodation and passenger transport. The rules begin applying from 2028. Pillar 3, the single VAT registration. This simplifies cross-border VAT compliance. It includes expansion of the one-stop shop, import one-stop shop for goods equal to or under €150, and extension of the EU VAT SME scheme. The objective is to reduce the need for multiple VAT registrations across member states. So now let me walk you through the ViDA implementation timeline, which was crucial. ViDA will be introduced in 3 phases, gradually expanding the scope of obligations between 2028 and 2030. The Revenue Commissioners will be responsible for this rollout. Phase 1 begins in November 2028. From that point, large corporates will be required to implement mandatory domestic business-to-business e-invoicing and real-time digital reporting. Importantly, from November 2028, all businesses, regardless of their size, must be able to receive structured e-invoices. So even if a company is not yet required to issue e-invoices, it must have the systems in place to receive them. Phase 2 starts then in November 2029. At this stage, the obligation broadens. All VAT registered businesses involved in EU cross-border business-to-business transactions must adopt e-invoicing for domestic business-to-business transactions as well. So the scope expands beyond large corporates to a much wider business population. And then we move to phase 3 in July 2030. From this point, all cross-border EU business-to-business transactions will require structured e-invoicing and real-time reporting. At that stage, the traditional VAT reporting system for cross-border business-to-business trade is effectively replaced by a transaction-based digital model. So the key takeaway is this: by 2030, e-invoicing and real-time reporting will be the default for cross-border EU trade. And preparation cannot wait until the final deadline, because system readiness will already be critical from 2028 onwards. So let me now turn to what this means in practice for businesses. There are 5 key steps companies should be thinking about. Step 1, identify your customer status. Businesses must determine whether a transaction is business to business or business to consumer and validate VAT numbers in real time. The place of supply is determined at the moment of the transaction, which directly affects reverse charge treatment and reporting obligations. In the short term, this means IT investment, process redesign, and potential software upgrades. In the medium term, however, It should lead to simplified cross-border compliance, fewer fragmented VAT registrations, and greater legal certainty. Step 2 is to determine platform involvement. So under current guidance from the Revenue Commissioners, an electronic interface becomes the deemed supplier when it facilitates distance sales of imported goods valued at €150 or less, and intra-EU supplies where the underlying supplier is outside the EU. In those cases, the platform must collect and remit VAT and may opt to use one-stop shop or import one-stop shop. It is treated like any other supplier for VAT purposes. From 2028 under ViDA, the deemed supplier model expands further to cover accommodation and passenger transport facilitated through platforms. Step 3, assess your one-stop shop obligations. For cross-border business-to-consumer supplies, the Union One-Stop Shop system allows businesses to file a single quarterly return through Revenue's ROS system rather than registering in multiple member states. For SMEs, this is a major simplification tool. However, if a business opts into one-stop shop, all eligible supplies must be reported through it. The non-union one-stop shop scheme exists mainly for non-EU businesses supplying services into the EU, relevant for completeness, but less central for Irish SMEs. Step 4, assess import one-stop shop or special arrangements for imports. Import one-stop shop applies where goods are located outside the EU at the time of sale, valued at €150 or less, and not excise goods. The benefit is that VAT is collected at the point of sale, no VAT is charged at import, and a single monthly import one-stop shop return is filed. It also avoids unexpected customs charges for consumers. Special arrangements can be used instead of import one-stop shop, typically by postal operators, involving deferred VAT collection at import. It is worth noting that some guidance reflects the 2021 e-commerce reforms and may evolve further under ViDA. And finally, step 5, prepare for structured e-invoicing. Businesses must ensure their accounting and invoicing systems can generate invoices in the European standard format and transmit them automatically to national tax authorities. This isn't just a formatting change. It is a shift towards digital, transaction-based VAT reporting infrastructure. So the overall message here is clear. Customer identification, platform status, cross-border VAT schemes, and digital invoicing capability are no longer optional compliance issues. They are becoming core operational requirements. Now I'll hand you back to Niamh to discuss the timeline a bit more.
Okay, so looking at the first timeline, the Commission published the proposal in June 2023, with a provisional agreement reached in November 2025. For PSD3, Ireland will need to adopt national laws on settlement finality in late 2027, with Ireland transposing remaining rules into national legislation also the same year. For PSR, the full application is expected in late 2027, while specific rules on payee identifiers and liability are expected early the next year. Looking at ViDA, the Commission published a proposal in December 2022. Record and ISS rules will be in July 2026, while Phase 1, which is domesticated B2B e-invoicing for large enterprises, in November 28. Then Phase 2 on cross-border EU B2B invoicing for VAT-registered businesses will be November 29. Phase 3 on all cross-border EU B2B and B2G e-invoicing mandatory structured format automatic reporting will be in July 2030. So now we will look at the opportunities and the implications. So starting with payments, the reform will create safer cross-border payments, particularly through stronger fraud prevention measures and mandatory verification of payee. There will also be clearer refund and liability rules, which should reduce uncertainty for businesses and consumers. And importantly, the framework supports greater competition and Fintech integration, especially through the Open Banking 2.0 and Uniform EU operational rules. On VAT, the opportunity is more structural. So VAT data will move towards near real-time reporting, which improves transparency and reduces fraud. There will be greater automation of compliance processes, and over time, this should lead to reduced administrative complexity, particularly for cross-border businesses using one-stop shop and simplified registration models. However, there will also be clear implications. So VAT system upgrades will be required well before 2028. Businesses will need to invest early in structured e-invoicing capability. Customer verification will become central, particularly VAT number validation and correct classification of business to business versus business to consumer transactions. And there will be compliance costs. So new reporting obligations and system requirements mean upfront operational adjustments. So overall, this is a shift toward a more digital, harmonized, and resilient system, but preparation and investment will be essential to release the benefits. I will now hand you back to Una to talk about what support and resources are available to you.
Thanks, Niamh. So we'll finish this section of the webinar by pointing you towards some useful resources if you'd like to explore these topics in more detail. On the payment side, the Checkout.com Resource Centre provides practical industry insights, particularly on implementation and market developments. For the legislative and policy perspective, the European Commission's Payment Services page is the primary source for updates on PSD3, the Payment Services Regulation, and related reforms. On the VAT side, the Revenue Commissioner's website is essential, particularly their guidance on ViDA and VAT modernisation. They provide detailed information on implementation timelines, deemed supplier rules, the one-stop shop, and the import one-stop shop. Given that much of ViDA will be phased in over several years, monitoring revenues guidance will be absolutely essential, as technical and administrative updates as to how they intend to roll this out will continue to be announced over the coming months and years. So that concludes this section of the webinar, and I'll now hand you over to Ruth.
Thanks so much, Niamh. I'm just going to very briefly speak about FEXCO and what we do. So we might move to the next slide and I'll just explain what we're about. So our focus is on delivering fresh thinking in payments and business services. And very briefly, in case you're not familiar with us, we're based in County Kerry. We were established over 40 years ago, and we work with a variety of partners, particularly financial institutions around the globe. By global standards, we're a mid-sized business, but by Irish standards, we're a large business employing over 2,800 people. That number has gone up quite significantly in the last year. And we process a very large volume of transactions with our partners. And we work very closely with government, among other partners, to deliver services out to the market. So I can go to the next slide. So just to explain who we are, and the next visual as well. I might start from the bottom and go up just to explain how our history kind of relates to some of the stuff we're talking about in ViDA and the third Payment Services Directive. We actually started doing business process outsourcing back in the 80s in the form of VAT return processing, when it was incredibly paper-based. And that involved shipping very large volumes of paper to our offices, digitalizing them for our corporate clients in the UK and Ireland, and completing their VAT returns for them. So we have been involved in VAT processing since it was extremely manual, and the idea of any kind of digitalization was considered to be revolutionary. We've evolved a managed services business primarily aimed at ensuring that our partners can digitalize their processes and deliver, I suppose, high-grade business process to their underlying clients. And that's continuing to evolve, which I'll mention in a minute. And if you look to the right of the right bottom corner of the slide here, you'll see that we were involved in digital tax-free shopping. So we introduced the concept of enabling holidaymakers to digitally process their VAT claims when they're returning back to their home country. And of course, that's something we all take for granted as being an incredibly simple process today. Throughout the 90s, then we went on to develop other products that leverage technology to solve consumer problems, particularly dynamic currency conversion, which is for card payment processing. And we developed an international payments business, which is particularly interested in PSD3. More recently, we've continued to leverage on technology and innovation as our strengths. So we developed an RDI hub here in Kerry to support the next generation of innovation with the aim of having a cluster for Fintech innovation in the Southwest. And we are very happy to work with the likes of Enterprise Ireland on encouraging growing businesses and innovators through the hub. And we established a payment gateway, which is a direct payment processing solution for merchants, noting the fact that although card payment processing has come on by leaps and bounds, it's still quite difficult for merchants and consumers to get the experience that they want at point of sale, and we have the expertise to enable them to do that now. Finally, just to note, we moved from a million years ago being involved in managed services, outsourcing, addressing huge paper-based problems with fairly simple technological solutions, to now providing advisory services in areas such as AI adoption for our clients, fully anticipating that in future administration is simply going to be automated. There won't even be buttons to click. So that's kind of a whistle-stop tour of what we do and the vision that we have of how markets, consumer behaviour are going to change. Now, moving to what we've just heard about PSD3 and ViDA, I'm going to give a very brief view of how it looks from our perspective. Firstly, with PSD3, I think it's important to remember the key drivers that caused the EU to go again, and hope that the third time will be lucky for payment services at the EU level. The key drivers there is this need for payments sovereignty, which they sometimes refer to as open strategic autonomy at EU level. And that's, I suppose, a short way of saying that they're very concerned about the dominance of Visa, MasterCard and other key players in the payments market in Europe. And there's a growing understanding that we need to be able to stand on our own 2 feet when it comes to processing payments at a consumer and a business level. So they're going to keep at this until we reduce our dependence, particularly on card schemes, and evolve our own ways of processing payments that don't necessarily rely on decision making that may occur in somewhere like, say, Atlanta. The next thing is a response to technological change, and that also touches on the next point. So the way in which we pay is becoming more and more sophisticated, and our expectations are becoming more and more sophisticated, and banks and payment processors throughout the EU are responding to those technological changes at differing rates depending on consumer behaviours that they're encountering. So it's not well coordinated. The EU wants us to have a shared vision of how the payments market is going to operate. So they're very, very progressively working on a kind of common rule book of how we're going to do things. And they do have an intention of driving innovation through regulation, which some people would say is a little bit unrealistic, but they're not giving up anytime soon. The other thing that ties to that is the fact that fraud is becoming more and more sophisticated. So we're all in a global market now. It's quite possible to reach another person from the other side of the world without them necessarily knowing who you are. Payments are so much more instant. People do them without thinking. There is no time to retrieve funds once they have been sent. All of these issues feed into the need for us to have really good regulation of payments activity, because there's just so much more risk. So technological change feeds the opportunity for sophisticated and immediate fraud, and we have to respond somehow. So the EU Payment Services regulation is a means for us to ensure that consumers remain safe as they engage with newer technologies and release funds more quickly across the markets. In terms of impacts, the impact on consumer payments of PSD3 is probably not going to be huge, because we've already got instant payments for consumers. It was launched under a separate piece of legislation. Consumer-to-consumer payments now can be made instantly using SEPA, instant credit transfer. So you may have been invited to take advantage of that on your banking app. With ZipPay, it's the intention that the Irish banks will be able to offer instant consumer-to-consumer payments from one bank to another, providing a realistic alternative to Revolut. So that's kind of a problem that is deemed to be already solved. However, whenever we travel, we do tend to go back to using card. So it's quite possible that PSD3 is going to, I suppose, open up a more European view of payments. As regards business payments, PSD3 could potentially be very impactful. So something to bear in mind is that instant payments are hugely advantageous to consumers who only have a certain amount of money in their wallet, and they want to get it from A to B quickly to get the service that they need. Businesses, on the other hand, tend to have very long payment cycles, at least 30 days between the date that they're asked to pay and they actually pay. And they are not in a rush to release the funds or have them arrive at their destination, because business credit is quite freely available. So the idea that payments are becoming instant for businesses will have huge knock-on impacts on their processes, which may not have changed for decades. Finally, just to note the impact on existing payment institutions and EMIs, that's at a personal level. We operate a regulated payment institution here, and we're not keen to go through another authorization process as a result of the introduction of PSD3 in circumstances where it really doesn't change the rules of the game for us all of that much. But it is quite likely we will have to go through that, reflection of the fact that regulation is increasingly done at the EU level rather than at the level of the central bank or other member state regulators, which quite frankly is just a bit of a pain. So then those things said, I'll move on to the idea of e-invoicing and what that might mean for us. And actually this ties a little bit back to PSD3. The first thing to note, and I think this is covered really, really well in Niamh's presentation, was the fact that the impact for larger businesses and smaller businesses will be staggered. Larger businesses are first on the block for this. Ironically, they're the ones that are most likely to experience a very significant impact. So I pointed out here the issue of cleaning up supplier master files. Larger businesses tend to have very old ERP, often on premise. They have promised that they were going to move to cloud at some point. And now these changes are coming and they result in very significant process changes at the back end, particularly for mid-sized businesses that may be operating on-premise ERP, simply because if you're using cloud ERP, the accounting service provider is going to update their software at the back end, and you'll have seamless integration for e-invoicing as the various requirements kick in, or at least you can expect that that's likely to be the case. Larger businesses need to row their own boat here. They need to get ready earlier, and they need to make the changes in good time. So the previous practice of adding suppliers over a very long drawn out process and then maybe validating or not validating their VAT number and so on, that's all going to have to smarten up if we're to deliver all the benefits of e-invoicing at the level of a large business. The next thing to note is that VATable and exempt activity are going down different paths here. So VATable activity is subject to e-invoicing rules, exempt activity is not. So it's quite possible that particularly larger businesses that are doing both, for instance, financial services firms, will find that they are implementing e-invoicing in quite a rush for their normal VATable activities, but then looking for other ways to continue processing exempt activities without having to introduce any significant process changes. Likewise, we talk about cross-border activity being within the scope of the invoicing rules. External cross-border e-invoicing activity is not. So you may end up with kind of a dual approach there, notwithstanding the fact that platforms are going to be deemed suppliers. That's just an attempt by the authorities to avoid revenue loss, something that's a common theme across all of the major tax authorities globally, and something they've been working on for quite a long time. So I touched on the drive to cloud ERP already. I won't go over it again. That cross-border element is something that's very interesting to us, particularly in FEXCO. To note, PSD3 on the margins of the legislation, they are attempting to address cross-border activity, but it seems that we still have this final knot to unpick relating to cross-border global transactions. They get some attention, but possibly not enough to solve the problem of global VAT loss, problems of customer negative experiences when they travel outside their home jurisdictions, and the need for immediate consumer services that meet a standard they would have experienced if they were at home. So having noted all of those, I might hand back.
Thanks very much, Ruth. That was a really good overview of the changes and the impacts for Irish businesses. So just from an Enterprise Ireland perspective, we offer a suite of digitalisation and R&D supports that Irish companies can leverage to modernise and digitise their operations, to build new digital capabilities, and to develop innovative products and services. Companies can choose to do this on their own. They can leverage external help in the form of consulting or external IT service providers. And they also have access to an EI supported network of technology centres, innovation hubs, and technology gateways. So there's a big ecosystem of support out there that companies can leverage if they choose to do so. So if we just focus on digitalization supports initially, and those supports will be relevant for companies that have to adapt their current operations to kind of succeed in the new digital era. So the entry-level support for this is an Access Advice Digital Discovery support. So this is quite a small support but companies can use it to explore digital technology adoption opportunities, or how you can incorporate AI into your business operation. With the support, you can hire an external advisor to assist you with your evaluation. And our grant support is up to 80% to a maximum grant amount of €5,000. So it's very much an entry-level support. Once you've worked out what digitalization initiative you want to undertake, then there is a digital process innovation grant, which provides up to 50% grant funding towards a maximum grant of 150,000. So it is just important to note that you can't access this grant just to implement a new software system or just to meet the regulatory changes which have just been described. This support is intended to help you transform your operation and to implement substantial improvements in how you operate your business. So there needs to be a broader digitalization objective rather than just meeting the regulatory requirements which have just been discussed. In any event, given the pace of technology advancement and digitalization, there are so many additional benefits which companies can achieve from, moving forward with an ambitious transformation program. So then beyond digitalization, if we focus on R&D, and this might be relevant particularly for any financial services or fintech companies on this webinar who may be trying to pursue opportunities arising from the changes just described in this session. So Enterprise Ireland R&D supports are focused on helping Irish companies to develop innovative new products and services that you can sell on to your customers. So we have an entry-level support exploring innovation, which is really designed to help you think strategically about the technologies that are now available, the disruptive technologies that you can leverage. We also encourage you with the support to look externally for inspiration and guidance, so that you can identify a truly innovative and potentially disruptive product or service which you can bring to market. So the typical activities that companies undertake leveraging this support include feasibility assessment, prototype development, and then really planning out your product or solution development plan. The total grant is up to 50% funding with a maximum grant of 35,000 towards internal and external resources that you may want to use for that exploring innovation project. And then finally, the larger support is R&D funding. And this is a larger grant to help you actually proceed with the development of new products or services. It's important to emphasize that there needs to be technical uncertainty, which you're trying to address as part of this new product or service. It must be non-routine, and it must represent a significant step up also in your R&D capability. So the funding support here, it varies depending on company size. So it ranges from 25% for large companies to 45% for small companies. If you are interested in pursuing any of these supports over the coming months or years to address the topics covered today, then the first step is to speak with your Enterprise Ireland client advisor, and they can guide you through all of this. And there may be some ancillary supports also, which may be relevant. But again, your client advisor can walk you through all of those options. Thank you.
Thank you, Bernie. So thanks to everyone on the panel. That has been a really helpful overview of the regulation. Hopefully client and business representatives on the call now have a bit more of an understanding of what's coming down the track and feel more comfortable in how they're going to prepare. We have some time for questions, and I can see that there are quite a few have come in already. We won't be able to get through all of them, but we will do our best to follow up with you after the webinar where we can provide further guidance. So first question that has come in, I think this one is probably for Vulcan. What do IT upgrades for e-invoicing look like in practice? Do we need to replace our accounting software completely? So Una or Niamh, if I could ask you to take that, please.
Thanks, Anna Maria. I'll take that one. So in most cases, no, SMEs will not need to replace their accounting software entirely. Many existing providers will update their systems to support structured electronic invoicing in line with the European standard, so EN 16931, which underpins the ViDA framework. The practical test is whether your current system can generate structured XML invoices, integrate with a PEPL access point. So for example, through the pan-European infrastructure operated by OpenPEPL. So do take note of that, PEPL, P-E-P-P-O-L, and transmit data in a format compatible with real-time or near real-time reporting requirements. For many businesses, this will involve configuration changes, API integration, or module upgrades rather than full system replacement. That said, we're still awaiting further detailed guidance from Revenue on the precise technical implementation in Ireland, because although the package was formally adopted in March 2025, national implementation mechanics are still being developed. So please do remember to monitor updates from the Revenue Commissioners and keep an eye on their website for further technical information while the system readiness planning proceeds.
Okay, thank you for that. The next one that comes in, I think it's back to yourselves again. Does PSD3 affect ordinary SMEs who are not payment institutions?
Thanks, Henry. I'll take this one. So for the majority of SMEs, the impact of PSD3 will be indirect rather than regulatory. Most businesses will probably fall into the category of payment service users, not payment service providers. So this means that they are not subject to licensing or prudential supervision requirements. However, SMEs will benefit from enhanced consumer and transaction protections under the new framework. So as we previously shared, key practical changes include stronger fraud prevention measures, mandatory verification of payee, and clearer refund and liability rules. So while SMEs will not typically carry new regulatory obligations under PSD3, they should experience greater payment security, improved transparency, and a more uniform operational environment across the EU.
Okay, thanks, Niamh. I think the next one is probably for Ruth. In order to send and receive e-invoices in Irish revenue, adding any rule or requirement that will require companies to invest in specific software rather than working with the existing ERP?
No, I suppose that's back to Una's point. You're not obliged to buy anything in particular. There are certainly service providers already emerging, offering things like an API integration to your ERP, taking the data from your ERP at the frequency required to do e-invoicing. The devil there is in the detail. So you can buy those applications. There'll be any number of providers out there offering those types of services. And then you'll need to think about how you're going to plan and implement the changes necessary to be able to use their APIs within your package. Particularly, like I said, if you're on-prem. If you're in the cloud, I would expect that your cloud provider is ready for this and excited about it because it leverages the benefits of being in cloud. But if you're on-prem, yeah, you need to look around to see what tools you might want to interface with off your existing accounts package, and determine whether there are any changes you need to make, not merely within your systems, but also within the data set that you have. Is it possible that you might have poor quality data? Thinking again about PSD3 and the likelihood that you'll need to validate for instant payments further down the line. Could you have some kind of ghosts in the cupboard there in relation particularly to payee data, poor validation practices? All of those things are going to come out in the wash. So you will implement integrations, possibly using a third party. Those integrations will take work. And then once you've implemented them, any inadequacies in your existing data will start to become apparent. So you need to probably think about those two things in preparation for implementation of the ViDA requirements and PSD3.
Okay, thanks, Ruth. Okay, folks, I think we'll begin to wrap up with that. Thanks so much for your input today. I hope that the information provided by our panel this morning has been valuable. Many, many thanks to Una and Niamh from Vulcan Consulting for their expertise. Special thanks to Ruth McCarthy from Fexco Group for the insight around supports available to SMEs, and to Bernie Neville for providing the Enterprise Ireland perspective. As I said earlier, this is the final of a 6-part series of webinars unpacking upcoming policies that will affect Irish businesses. We hope you've enjoyed the series and thank you for attending. And recordings of these sessions will be available on the Enterprise Ireland website. Thank you all and goodbye.